Hey everyone, welcome in to a special Sunday daily editorial here on the KE Report. We're chatting with Rick Bensignor, and we are going to, as always, be diving into a wide range of sectors. And Rick, that we really appreciate, always shares the way he is positioning him and his clients in more of that short to medium term trading. Rick is the president of Bensignor Investment Strategies, writes the institutional newsletter, Supposedly Irrelevant Factors. That is read by some of the most successful hedge funds in the world. On the retail and individual side, you should check out In the No Trader, that website, which has 3 products: a monthly report called 7-Eleven, where Rick picks no more than 7 of the 11 Spider ETFs with the goal to beat the S&P, which we have heard Rick has consistently beat the S&P. There's a weekly report called the Tactical Trader Report and a daily called the Daily Tips Sheet. Rick, let's get right into the theme that developed and really started last Thursday on July 11th on the back of the lower than expected inflation CPI data, a rotation out of big tech into small caps. We saw huge volume come into small caps and a very quick, almost spike higher move in a lot of these small cap and interest rate sensitive names. Rick, how did you play it? How sustainable is this?
Well, hey, Corey. Hey, Shad. How did we play it on July 12th? That would be, it's 19th. So that's last Friday. The daily tip sheets trade recommendation was to buy the Russell 2000 ETF IWM and put on a pair trade by shorting QQQ against it, which I suspect was probably ended up doing better than if you had just bought IWM outright. So you had a hedged trade, but it's worked very nicely so far. It's up 500, a little over 500 basis points in a week. We've taken half off the table just because when you make 5% that quick and you're in a trading oriented type of, I won't say environment, but the daily tip sheet is geared around short-term trading. I'm going to take 5%. When you quickly have it, we're going to take half off. Sustainability is questionable right now. I think we still have a little room to go over the next few days that can go to the upside, but sustainability is really going, I think the conversation needs to focus around the sustainability of small caps still being well bid for. The concept of that, the reason why the street is doing that, is their belief that the Fed is in fact going to lower rates. Now, there's been a defined shift in Fed fund futures, and now there's essentially a complete agreement that you're going to get a September easing and possibly another one in November. But the reality is, at least for now, is that on the 10-year side, the U.S. 10-year Treasury just bottomed a couple days ago at 4.14%, which is 1 basis point above the 4.13 level that I've been telling my clients and your listeners for the last few months is the critical support level that needs to break in order for the whole shift to take place, that rates will spend the back half of the year trading lower. By the fact that has not occurred and 4.13 continues to hold as support in yield terms, says to me that this rally that we're seeing here in small caps could be a short-term one, but nothing more than that, because at this point, the market has still not proven that rates are going lower. It's a hope. It's what people are betting on. But clearly, there are people on the other side of that trade who are selling bonds down at the lows of this week in yield terms, who already have a 10 basis point move in just a couple of days. And I think it's really important to focus on this level. And the more you crack under 4.13, especially on Friday closes, the better chance is that the higher for longer scenario that's been in place for quite some time now will then finally dissipate, and we will see yields back under 4%. And that could easily happen in the back half of the year. But for right now, bond bulls have had multiple attempts to break out from that level in the last month or two, and they just can't do it. And therefore, I told one of my largest fixed income clients this morning, I sent him an update to just say, for all the talk of lower rates, it's not ready. It's just the market's not ready for that to happen. And perhaps smart money is actually selling out of bonds. And it's very possible the bulk of the street is wrong. And I, too, have been positioned for rates to trade lower, but I put that trade on at 4.6%. So I have some cushion here to play with. But even I'm thinking of potentially reducing my bond exposure simply because after multiple attempts in the 4.21 to 4.13 zone that I had identified 2 or 3 months ago as being the critical support zone for yields, this is the third time down and they just can't break. So I'd say you potentially have a fair amount of people that have positioned for yields to go lower and they have nothing to show for it yet.
Rick, it's an interesting point of view, and I guess I want to contrast it with a couple interviews we did earlier in the week where people had mentioned they expect the yield curve to normalize and actually uninvert. Sometimes that can be a signal, more so than the yield curve inverting, that maybe a economic contraction is on the horizon. But with everybody moving into small caps, anticipating these lower rates because it's a better cost of borrowing for the small businesses, another person or two has noted that often that's a signal that we're near the blow off top part of a market. When the small caps finally do kick it in gear, sometimes it's end of cycle activity. What do you think of those two ideas of the yield curve uninverting possibly being contractionary and the move into small caps possibly being the last hurrah?
Well, this is something I highlight in my institutional piece each week, the 2s to 10 spread. And right now, over the last couple of months, you have the chance for a double top in that ratio. And it's literally sitting on the cliff. If this widens out a bit more, you will have a greater inversion. And if it happens, it's going to come swiftly. And there'll be a significant move in the yield curve very quickly. However, as of right now, it has stopped against resistance, again, in the spread between the two, right where it needs to. And if this ends up holding, then you could see a reduction of the inversion and getting more towards a normal curve.
Now, again, a lot of this change all happened on the back of one data point, that CPI inflation data. This can all change on the back of more data points and also the Fed meeting coming up in, I believe, a week and a half, let's say. What are you going to be watching in that meantime then, Rick, outside of just the markets to give you some maybe confirmation that, yes, the market is wrong and again got over its skis a bit too far ahead of itself?
So I think the US 10-year, having bounced where it did, can easily get back to the upper 4.3s. That would be kind of its first challenge point of yield resistance, and where if it's going to fail, if rates are going to fail to the upside and come back down, that's where it kind of needs to do so. So I'm prepared, and I've prepared my clients for the fact that this bounce that we're seeing can continue to extend. And frankly, until the Fed meeting, I kind of observe more to see what people are doing. Are they squaring up books? Are they reducing their fixed income holdings and seeing yields move higher? Or are they going to be kind of sticking with things? So my guess is, because there's so many late to the game people who have just now recently decided that yields are going lower, I'd say, just based on my 40 plus years on the street and the fact that I approach markets using the knowledge I have of behavioral finance theory, and that generally portfolio managers tend to make the worst decisions at the worst times, it makes me think that kind of, quote, dumb money got into the concept of yields going lower very late in the game. And my guess is we do see yields move higher in the short term as some of these late bond buyers get forced down and see losses amount fairly quickly. So, if we get up to somewhere around 4.4 before the Fed meeting, it would not surprise me. And then really got to just see what the Fed says, what's the real message that Powell's going to say, if anything different. And part of winning on Wall Street is gaming the marketplace. And I think so many people on the fundamental side who study the analysts and the strategists out there who use the knowledge that they were taught on how to evaluate markets, they do so through a fundamental eye, and they don't realize how much of price movement is gamesmanship. And they miss so much of big moves because they're only looking with what I'll say is the fundamental analyst way of looking at things, and they don't realize how much, whether it's charts, whether it's psychology, whether it's understanding positioning, how much of that has to do with the human decision-making process and where and why and when portfolio managers make the decisions they do. For me, having spent, if you look at my 40-year career, I spent a dozen years trading commodities in the pits back in the days when there were still floors, commodity trading floors. And you learn a ton about psychology and markets when you are literally in the thick of things. Then I went to Morgan Stanley on the sell side, and I spent years there. And then I spent a few years on the buy side. So I kind of have the eyes of someone who's been in all three major roles on the street, sell side, buy side, and real trading. And I think it allows me to look at markets in a different way than most of the analysts and strategists on the street who have focused in on generally whatever you're a sell side analyst, you're generally a sell side analyst. You grew up in that space and that's where you are. People on the buy side often don't have sell side experience, and most were never professional traders. And the fact that I have all three, I really do think gives me a significant edge over the average person who does this. It was funny. I was just watching something on CNBC this past week where somebody made a comment that, boy, I would not want to be a Wall Street strategist. It's one of the toughest jobs out there. And the thing is, it's not that tough if you understand all three sides of the game. If you only came from the sell side and you grew up as, let's say, an analyst who then got promoted into being a strategist role, you don't understand trading and you don't understand how the buy side thinks. And it's what allows me to come up with months before we ever get there, the key levels. Just even here on the fixed income side, months and months, at least 6 months, possibly even close to a year before we ever got there, I identified 4.72% as the key resistance level for bonds. This is after the 5% high had been made and we sold all the way down to 3.79. And when we got to 4.72, I told people, if you're going to bet that we're not going to 5%, here's the time and place to buy bonds. And we sold down and then we rallied again. And from 4.55 to 4.65, I said, if you think that 4.74 is going to hold for the yearly high, then here's where you buy bonds. And that's, again, where we topped in rates. And I said the key level is 4.21 to 4.13. And you need to break that in order to change the game. That's understanding. That's more than just like chart reading. That's understanding where people are positioned and how and when they're likely to be forced to change what they've done, often with big losses. And when PMs have big losses, they get to the point where they just say, get me out, whatever the price, I don't care. And that's really where you get to make money as a counter trend trader. It's really kind of understanding where people make the biggest mistakes, and they generally do at the worst times for them and the best times for someone who's looking how to take advantage of that.
Well, Rick, we sure appreciate having you on to cover not just the fundamental side, but the technicals, the market psychology, the positioning, what people are doing on both sides of the trade, because it gives us a more holistic view of what you think's happening in the markets. Just to that point, we talked a little bit about the rotation trade. I'd like to dive into that just real quick. It seems like there's been a move out of things like NVIDIA, let's say, that was to scorching higher, but maybe into the small caps. But we're also seeing other sectors like the financial sector doing better. We're seeing some of the smaller tech stocks get a bid as opposed to just the mega cap tech stocks. We're seeing REITs get a bid. We're just seeing a little bit of rotation into different sectors. Do you think it's a healthier market now, or that it's just investors on the psychological side trying to chase momentum and bigger gains that they maybe can't see in the mega cap tech stocks at these values?
Well, look, the Mag 7 names that had tremendous runs, and the fact that we're seeing profit taking in them is no surprise that you finally collectively have some profit taking that actually works. So the fact that some of these names are down 10, 20% or more off their highs is good, and it's good to see the market broaden out. But the broadening out of the market, Chad, is really coming from the belief that rates are going lower, and therefore it's broadening out to the cyclical names. Instead of having 7 names represent as much as what I think recently was 35% of the S&P coming from 7 of the 500 names, you're starting to see some of the other cyclical sectors perform, even something like REITs, which have gotten a sharp bounce recently. But why have they gotten a sharp bounce? Because there's a belief that rates are going lower, and REITs are associated to fixed income. And if fixed income rates go down, then REITs and utilities usually tend to do better. Now, utilities had their run a few months ago, and they've actually been losing ground steadily. But REITs and utilities combined don't even equal 6% of the S&P. The reality is, even though REITs are running right now, in the world of portfolio managers who are benchmarked to the S&P 500, most couldn't care less about those two sectors because they're tiny, virtually meaningless sectors. It comes down to the bigger sectors: tech, consumer discretionary, communication services, financials, industrial. I'm trying to see if it's not generally energy, because it's still a somewhat small sector, even though a lot of people are focused on energy. Not REITs. Staples is about 6 or 7%. It's the other ones that really are the ones that matter, and that's where you really have to pay attention to the shift going on. And you are seeing, in at least pockets of industrials, pick up. Communication services have come under some pressure because what you're really talking about is Google and Meta, right? 2 of the Mag 7 names. If Mag 7 gets under pressure, then by default, XLC, the communication services ETF, is going to come off hard because there's some real serious profit taking there. So there's the amount of people, the amount of portfolio managers who are benchmarked to the S&P 500, who in a year like this can outperform when you have a broadly diversified portfolio, is very small. Because even if you're overweight tech, there's only so much you can be overweight tech. And if you've got a mandate to be spread across the S&P, and it's really just a matter of overweighting and underweight sectors, it's very difficult to outperform in a market like this that has been so concentrated. So it's a good thing to see other sectors get a bid. The question is, how long will they get a bid, and what's it going to take for large cap names to start, especially the high end of large cap names, before you start seeing people come back into them. And I don't think we've seen a move yet to define that Mag 7's done coming down, but I don't think you're going to want to be on the wrong side of that when it happens.
Yeah, fair enough. There's just so much money in those Mag 7 names that even just a broadening out can really move some of these lagging sectors very strongly. That rotation trade, it's something we've talked about for a couple years now. Rick, I want you to put on your commodities trader's hat. Back in the day when you were on the floor at the commodities floor and trading desk, I want to look at gold, but first I want to look at copper, because copper has had just a wild ride. You go back to early April, copper was in the, let's say, 420 to 430 region. It went up to 520. It went up over 20% by about mid-May, and now it's the whole way back to about that 420, 430 level. What's this telling you? Is it telling you anything when we see copper go on a run like that and a correction almost just as quickly?
So here's the thing. Copper makes this new high in spring, taking out, I don't know, a 3-year high. So there had been, let's see, if we were talking about COMEX copper, let's say between $4.75 and $5, a pound, you had two highs, one in 2021, one in 2022. In 2024, we slightly exceed, and it was only for a week or so, but you slightly exceed those highs. Stop at a target at, I had 517. And then we quickly sell off, get a bounce to about 475, and it sold off, as you say, into the low 420s. The rally in copper, basically, let's call it from January 1st this year, that all came without China purchasing much copper and their economy. Just look at how equities are doing in China. This is a sad story of a country right now when it comes to economics and their capital markets. I was already suspect that the rally in some way or another was kind of a BS rally based again on positioning, looking at where flows are, looking at what exposure hedge funds had, which kept buying and buying copper. And they were right, but they probably didn't get out well. And now a lot of the profits that they had, their paper profits, are gone. I can tell you right around where we're trading now, in and around this 423 level, is a significant level. It's just a tad underneath the January high, and it's kind of a measured move off of what was not the January 23 high, and what is a measured move off of this year's high. So I think copper either holds right in here or it goes back under $4, and you're talking about seeing 375-ish or lower come into play. To watch the copper run without really China doing the buying they need to do in order for copper to have a sustained rally. Yeah, it was sustained for a few months, but that trend is kind of gone. And China looks pretty darn awful. So the movement is far more trading oriented. And when I say trading oriented, I don't mean it has to be a 1 or 2 week move. But it's the difference between the likelihood that the copper move was real versus gamesmanship and understanding who was buying copper. And when funds buy copper, they generally are buying it because of, I'd say, far more technical models than purely good fundamentals. And the more market rallies, the more these commodity funds buy more contracts. It's interesting because they don't look to sell when they have profits. They look to add when they have profits. And open interest is starting to finally come off, and which means that you're kind of right where you were in open interest terms. And when this thing lifted off above 4.25 earlier this year, which means the funds really didn't get out. The move doubled their way, but only now are they really starting to get out. And so winners and losers net out over time. And who are the winners? Well, to allude to the movie Trading Places, the Duke brothers are the winners. It's the brokerage firms who are collecting commission, because your average copper trader, especially a fund, is generally not quick enough to take advantage of the moves that have taken place, because they keep adding as price goes up. They don't sell.
Rick, it's just an interesting environment with copper. We kind of are in the commodity space every day, like in the trenches following along, and we saw a flurry of news reports, or I guess articles coming out hypothesizing that the AI trend had moved into copper. And for a couple months, we just saw a deluge of articles talking about data centers being built are going to require all this copper. Robert Friedland, one of the big copper bulls, billionaire friend, roommate to Steve Jobs and big magnet and the mining space, was pounding the table on social media about the copper shortages. And so a lot of this, people were saying, was happening beyond what's happening in China. And it's really about a need for the electrification. And that narrative caught hold, and then it burned out just as quickly. Do you think that something like that activated some of the trading, and that also it was a short squeeze potentially, and that the short squeeze ran its course and then was over just as quick as it started? Or how would you read into some of those things kind of beyond the China story?
Yeah, I think, articles like that get copper funds ultimately to buy more, because again, their mathematics work on doing what works. So if they're long and the market moves higher, they buy more. It gets little people in. I say little people, I mean the individual investor who starts looking at copper names or copper itself, although most little people aren't trading copper futures. But it gets smaller investors leaning towards that direction. And then the whole thing blows up in a second. Like, that move is very questionable right now. The whole first half of the year's move is now 50% of what's given back half of the whole move off of this year's low. And if it doesn't hold right about in here, I think that you're back into a large trading range. The 200-day moving average only has mild upward slope at this point. And if you look at a multi-year chart, now you have three tops between 475, and now we can extend that to 5.25. You're trading at right near 4.25. The low over the last few years was down in middle of 22, down at 313. So you're talking round numbers, 3-ish to 5.25, and you're trading 4.25. You're mid-range. There's no vig here. There's no edge. You can trade short term and you try to figure out from technicals which way the next few percent move is, but there's nothing here to make you think that copper has a long-term bull market coming, especially from those articles. If that was true, why and how did copper go from 520 to almost 420?
Yeah, what a wild last couple months for copper. Fun to cover both on the upside and on the downside, trying to make sense of it. Let's move over to gold, because gold has done better. I think you can make the argument gold is in a much better spot than the copper trade. Gold's hanging around those all-time highs. Hit all-time highs earlier this week, but then has also given a little bit back at the tail end of the week. What's your outlook for gold?
So longer term, I'm still positive gold, but, and it's kind of the big but. So gold's down almost $55 today. Why is gold down? Well, it hit some targets on the upside. So even though it made new all-time highs, it's hit some trading targets. And secondly, dollar's bouncing a little bit. Why is the dollar bouncing? Because yields aren't cracking. So the dollar's going to mostly move. We are been in a cycle for quite some time that the dollar moves with yields. So by the fact that 10-year yields held this critical level at 4.13%, are now 10 bips higher, the dollar's bouncing a little bit too. Now the dollar failed at 105 point. The dollar index failed at 105.90, and it's a level that I identified at the time as being a failure level. We sold down to, I don't have it in front of me, but low 104s, maybe even got into upper 103s. I think what you're seeing today in gold is new all-time highs that instantly don't hold, and that's questionable. Now, for short-term trading, I'm actually buying into this pullback. Today, I had clients scale down bid into the GLD ETF, but I'm not going to risk much more than 1% from here, because either gold's going to hold right in here, which is beneath what prior all-time highs were, and I said it's sold off beneath there because you'll get weak-handed longs to puke out. And I'll take the chance that it kind of holds right in here. And again, I'm not going to risk much more than 1.5% on this trade. So I have a defined sell stop on the GLD already in print for my clients, and it'll either hold here, recoup a little bit and bounce again, or I take a 1.5% loss, and I don't mind taking a 1.5% loss at all. And if you're trading, keep your losses small, let the good stuff run. And I'll give you some examples too of the type of things we do in the daily tip sheet. On June 26th, Tesla was trading at $190 a share. I had clients buy a 190-205 call spread. The same day we bought it in the morning, it was already worth 50% higher and hit my first trading target. And often on an option trade, we'll take partial profits at a 50% gain. So the very day we put it on, we already had a 50% gain and took it off. And then 2 days later, we were up 100%, and I kicked it out at 100%. So we made an average of 75% in 3 days trading. Now, Tesla kept going higher. We had a 190-205 call. Tesla got all the way up to 265. You'd think you'd do much better owning the stock, but the reality is in 3 days, we made 75%. If you bought Tesla at 190 to make 75%, you need a $130 profit. This thing went about $75. You only got half as much being in the stock. And then at 265 on July 10th, we sold a 265, 270 call spread because I could so closely define it's either Tesla's going to stop right here, which was against a prior high, but I had some measured moves against it. Also, that said 265. So it's selling a 265, 270 call spread. The same day, no, 24 hours after we put it on, was that Tesla announcement that they weren't going to do. Again, they announced like we're not going to do that robo-taxi thing, or it's on delay, and the stock fell $20 right after that news event. And the call spread we sold fell 50% instantly. So again, I took profits. We got out of everything with a 50% gain. So 2 Tesla trades in a matter of total of 4 trading days made 125% on your money. That's what timing the market can do, especially if you use options. And I've only used options. I think there's only 8 trades this year I put out in the daily tip sheet that we used options. 7 out of the 8 trades are winners, and total gain right now is 632% on your money, just correctly timing option trades. Understanding how and when to use different vehicles, understanding the odds of success, and doing the right time, especially for options. You got to get direction right and timing right. You get both those right, you get home run trades. And that's kind of what the daily tip sheet is about, and how and why we have the type of results I do. We pound away slowly and surely. Generally, trades are held 3 weeks or less, and it's really all about short-term trading. And for those who enjoy trading, and I've always told people in my lengthy career, your trading account should not be more than 10 or 15% of your total investable dollars. You should be invested for the long term. But if you like to play, don't take half your money and play. Take a small piece of it, because short-term trading is tough. You really need to know what you're doing to get ahead over time. But this is where you can really increment the returns you get over time in the market by having somebody who kind of knows what they're doing in that space give you some very added boost to what you're likely trying to do yourself. And look, most people lose when they try to trade the markets. And I've at least help my clients not be on the losing camp and actually be well up on the winning side.
Hey, trading's hard. Thanks for sharing some of your insights here, Rick, and some nice trades that you have put on. I think a lot of people are getting excited about this market, this rotation into some of the small caps. Again, all on the back of one data point. We'll see just how sustainable it is. And the next couple of weeks are going to be pretty important to see what sort of follow-up economic data we get, as well as what sort of comments we get at the next Fed meeting. I will post a link to the In the Know Trader website in the show notes so you can follow along and learn more about some of Rick's investment products. Rick, thank you very much for your time. I hope you have a great rest of your weekend.
You too, guys. Thanks for having me.